All right, so the one big beautiful bill is officially law, and if you make over $250,000 a year, it's got your name written all over it. I'm Mark Tepper, a CFP and also a tax strategist, and over the course of the last several weeks, my team and I, we've been living deep inside this thing, taking it apart piece by piece by piece, and I've already spotted how the new rules on deductions and write-offs could cost people who aren't paying attention tens of thousands of dollars. You see, the news will give you the headlines, but the devil's actually in the details. And those details are what will either save you a fortune or cost you one. So today, I'm not just gonna tell you what's changing. I'm actually going to give you the exact steps you need to take right now so that you can protect your income and keep more of what you've earned. We're gonna break down all the changes that specifically target high income folks and, more importantly, the strategies to turn these new rules to your advantage. This isn't just information, it is your new financial game plan. So do me a quick favor and hit that like button for the algorithm. It really helps us out, and let's get into it. Let's just be real. For years, if you're a high earner, especially with the business or maybe even a dual income household, it's felt like you're running on a treadmill. I mean, your income goes up, but your tax bill seems to grow even faster. You get phased out of credits, you get hit with surprise surtaxes, and you end up asking that classic question, how are we making this much money, but still writing a huge check to the IRS every single April? Well, the one big beautiful bill, which was signed into law on July 4th of 2025, is the biggest shakeup to the tax code since the 2017 Tax Cuts and Jobs Act. And while it does make some parts of that old law permanent, it also rolls out a whole new set of traps, but also some great opportunities. And the theme is pretty clear. There's going to be new hurdles for high earners, but for those of us paying attention, there are also brand new government-approved loopholes and strategies to legally slash your tax bill. Ignoring this really isn't an option. I mean, these changes are effective for the 2025 tax year, which means the money moves that you make from now, today, and moving forward will directly decide the size of the check that you write or the refund that you actually get in 2026. We're talking major shifts in how you deduct business expenses, what you can write off for state taxes, and even how your business income gets calculated. The problem is these changes are buried in hundreds of pages of legal gobbledygook. I mean, the solution is actually having a clear plan, and that's exactly what we're gonna build today. We're gonna kick things off with the biggest changes for business owners. Then we're gonna get to crucial updates for individuals and families. First up, and this is a massive win for anyone with a pass-through business, like an LLC or an S-Corp, is the Qualified Business Income Deduction, or QBI deduction. And this is honestly one of the most powerful deductions in the entire tax code, and it was supposed to die at the end of 2025. So here's a quick refresher. The QBI deduction lets owners of S-Corps, LLCs, partnerships, sole proprietorships, which pass through income to your personal tax return, simply just chop off up to 20% of their business income right off the top. So if your business had $500,000 in qualified income, you could get a $100,000 deduction, which saves you around $37,000 in federal taxes alone. That is a huge deal. The only problem is that it was temporary, so we could never really build long-term strategies and plans around it. Now, the one big beautiful bill, that changes everything. So first of all, it makes the 20% QBI deduction permanent. That's a game changer. It gives business owners the stability that we all need for real long-term tax planning. Now we can build out multi-year strategies around this thing, knowing it's not going to disappear and that it's not going anywhere. But it gets even better. So the new law also bumps up the income thresholds where the deduction starts to phase out. So before, certain service businesses like doctors, lawyers, consultants, financial advisors would see this deduction shrink or even disappear once their income hit a certain level. The new law raises those initial phase-in thresholds to $75,000 for single filers and $150,000 for married couples, and that means a lot more business owners can now claim the full benefit without getting tripped up by those old limitations. So what's the move here? Well, if you're a business owner, especially if you run a service business with income in that $250,000 to $700,000 range, you need to rerun your QBI calculations immediately. You might have been phased out before, but under these new rules, you could suddenly have a 5-figure tax deduction that wasn't there for you before. Now, the rules do still get complicated for service businesses at higher income levels, but this change opens the door for a lot more people to take advantage of this tax savings. So right now is the time to actually sit down with your CPA and model it out. You might want to adjust your salary, your owner draws or distributions, or even rethink your business structure to squeeze every last drop out of this now permanent tax break. The next big update is like a shot of adrenaline for any business owner who buys equipment, technology, vehicles. One of the most beloved tax breaks, 100% bonus depreciation, is back. So to understand why this is so huge, you have to understand what was happening. So bonus depreciation was being phased out. So it was 100% back in 2022, then it dropped to 80% in 2023, 60% in 2024, and it was going to keep falling. So that meant if you bought a $100,000 piece of equipment in 2024, you could only write off 60 grand in the first year. The One Big Beautiful Bill slams the brakes on that and actually throws it in reverse. For any qualifying business equipment you put into service after January 19th of 2025, once again, you can now deduct 100% of that cost right away. And critically, this applies to both new and also used equipment. So let's make this real. Say you own a construction company and you buy a new $300,000 excavator in 2025. Under the old plan where things were phasing down, you might have only gotten a 40% deduction, which is $120,000. Under the new law, you get to deduct the full $300,000 in the year you buy it. So assuming you're in about a 32% tax bracket, that's an immediate tax savings of $96,000 compared to just $38,400 under the old path. That's a $57,600 difference in your bank account just because this law passed. So the strategy here is pretty simple. If you're a business owner, you should rethink your entire spending plan for the next several years. That big equipment upgrade that maybe you've been putting off, well, 2025 might be that year. That fleet of trucks you need to replace, maybe now's the time. So this law is basically a massive government subsidy for you to invest in your own business. You get the assets you need to grow, and you also get an immediate tax deduction for the entire cost of that asset. It's basically a green light to invest in your business's growth and future. So let's switch gears from business stuff to one of the most controversial changes hitting high earners, especially if you live in a high tax state like California, New York, or New Jersey. And I'm talking about the SALT deduction, the state and local tax deduction. So ever since 2017, we've all been stuck with this $10,000 limit on deducting our state and local taxes. So for people in high tax states, like this was absolutely brutal. You might be paying $50,000, $80,000, $100,000 or more in state income, local taxes, and property taxes, but you only got to deduct $10,000 on your federal return. So it really felt like a penalty based on where you lived. The One Big Beautiful Bill tries to fix this, but obviously there's a catch. And the new law raises the SALT cap from $10,000 all the way up to $40,000. So it's not unlimited. There's still a cap, but it's gone from $10,000 to $40,000. On the surface, that sounds amazing. I mean, if you pay $40,000 in state and property taxes, you can now deduct the whole thing. But here's the tricky part. This benefit is targeted. So that full $40,000 deduction is only for taxpayers with a modified adjusted gross income up to $500,000. The second your income goes over that $500,000 mark, the deduction starts to phase out, and by the time you hit $600,000, the benefit is pretty much gone and you're right back to where you started. So let's look at an example. The Miller family lives in a Chicago suburb with a combined income of, let's say, $475,000. They pay $35,000 in state and property taxes. Before, they could only deduct $10,000 of that 35 grand, but now, since their income is under the $500,000 threshold, they can deduct the full 35 grand. That's an extra $25,000 deduction, which in a 32% tax bracket, that saves them $8,000 in federal taxes. Now, think about their neighbors, the Garcias. They have an income of $550,000. They also pay $35,000 in SALT. But because their income's over the threshold, their deduction gets limited and slashed. Now, the exact math is complicated, but they're going to lose a huge chunk of that potential benefit. So here's your strategy. If your income is safely under $500,000, this is a clear win for you. Enjoy that bigger deduction. If your income is hovering right around that $500,000 mark, you're in what I call the strategic danger zone, and that's where planning is everything. You need to find legal ways to manage your income to stay under that cliff. That could mean maxing out 401ks, using an HSA, maybe carefully timing when you sell investments, maybe asking your employer to give you a $10,000 bonus next calendar year, where you start to lump expenses and income together in specific years. So in the odd numbered years, you're still able to take advantage of some of these tax savings. Now, if your income is way over $600,000, sorry, but this change probably isn't going to help you that much. You're likely still stuck near the old $10,000 limit. And also, let's not forget, this expanded cap is temporary. It is set to go back to $10,000 in 2030, so you have a limited window to really take advantage of it. Last but not least, let's talk about the changes that affect you and your family, because some really big stuff happened here. First, starting with families and kids. There's good news. The $2,000 child tax credit per child has been made permanent. So there was a lot of talk about this going away. So having it now locked in provides some nice stability for family tax planning. On top of that, the One Big Beautiful Bill gives it a temporary bump to $2,200 per child for tax years 2025 through 2028. The income phase outs are still high. So it's $400,000 for married couples. So most high earners are still going to get the full credit. Second, the elimination of personal and dependent exemptions is now permanent. So this was offset by the much, much larger standard deduction, which for 2025 is going to be around $30,000 for a married couple, and is also now permanent. So that is a huge simplification of the tax code, and it's here to stay. However, one of the most sudden changes is the repeal of several popular energy tax credits. So the credits for buying a new EV, electric vehicle, a plug-in hybrid, installing a home EV charger, or making energy efficient home upgrades like energy efficient windows or solar panels are either being killed off or changed significantly. So here's the actionable strategy. This creates a very clear deadline. If you've been thinking about buying an EV or doing major energy saving upgrades to your house, you need to pay close attention to the dates. As an example, the popular EV tax credit worth up to $7,500 is sunsetting for vehicles purchased after September 30th, 2025. Other credits for home improvements are also set to expire after 2025. So waiting could literally mean leaving thousands of dollars in tax credits on the table. And that's a hard deadline, and you need to plan your big purchases around it. We've covered a ton of ground, and honestly, this is just scratching the surface. The One Big Beautiful Bill is incredibly complicated, and trying to navigate it without a plan is like trying to cross the ocean in a rowboat. You might get there eventually, but it's going to be a very difficult and rough ride. That's why my firm exists. We specialize in proactive tax planning and investment management for high-income earners and business owners who are sick and tired of getting surprised every single April. We don't just file your taxes, we build a year-round strategy to make the tax code work for you. So we help people navigate these kinds of exact changes whether it's maximizing the QBI deduction, timing equipment purchases so we can depreciate it, managing income around the SALT cap, and so much more. If you are making over $250,000 a year and you just have that feeling you're leaving money on the table, you probably are. I would invite you to book a free, no obligation consultation with my team. Just go to tepperzoom.com and find a time that works for you. We'll look at your specific situation and show you exactly where the opportunities are within this new tax law. The link is right down in the description. Do not wait until it's too late. So, what's the big takeaway here? The one big beautiful bill is not some minor tweak. It's a major overhaul of the rules for high earners. And for business owners, it's a story of huge opportunity. You've got the permanent 20% QBI tax deduction and the return of 100% bonus depreciation. It's a huge and massive green light to invest and grow your business. And the smartest business owners are going to be using these two tools to their absolute maximum. For individuals, the game has changed as well. The higher SALT cap is a lifeline, but only if you can manage your income to stay under that phase-out cliff. And the disappearing energy credits mean you need to act fast if you want to make those specific purchases. So the theme is this: complexity creates opportunity. The tax code isn't designed to be fair. It's a series of incentives, and the people who win are the ones who understand those incentives, and they build their financial life and financial plan and business plan around them. The strategies we talked about today: reevaluating QBI, accelerating equipment purchases, managing your income for the SALT cap, these aren't cheat codes. These are legal, government-approved methods written right into the law. Your job isn't just to earn a high income, it's to keep as much of that income as the tax law allows. And this new bill has drawn new lines in the sand, and now you know where those lines are. Thanks for watching. If you got value out of this, please subscribe and hit the notification bell so you don't miss our next update. And don't forget to check out that link in the description to book your free strategy session Zoom with me, and we'll see you in the next video.